Good afternoon, everyone, and welcome to Key Regulatory Updates. Today, we discuss what directors and executive management need to know about the bank regulatory issues that will be important in 2023. The presentation today highlights how these issues will impact banks and discuss key areas where directors and executive management should focus their attention. We thank you for joining us. My name is Lexi Grindstaff. I am the Director of Business Development at Bank Director. This webinar today is brought to you by both Bank Director and Covington & Burling LLP. An information resource to the financial community since 1991, Bank Director focuses on the strategic issues most fundamental to a bank's CEO, senior leadership team, chairman, and independent directors. Covington & Burling is a preeminent multinational law firm with over 1,300 lawyers and advisors worldwide. In an increasingly regulated world, Covington's sophisticated and Chambers-ranked financial institutions practice has the exceptional ability to help clients navigate their most complex transactional, regulatory, enforcement, and consumer protection matters. Today, we will be offering CPE or continuing professional education credits for this webinar. In order to qualify for credits, you must be in attendance for the full and complete webinar, and you must participate in all 4 polling questions. If you want to receive CPE credit for this webinar, please email Taylor Zito at tzito@bankdirector.com. Certificates will be sent out 2 to 3 weeks following the webinar. Before we get started today, I have a few housekeeping items to share. The first, you have joined the webinar in listen-only mode, and we cannot hear you. We do recommend today that you click on the slide bar at the bottom of the screen to put the presentation into full screen mode. If you have questions today for our speakers, you can note those at any time by using the Q&A button found on the right-hand side of your screen. Once our presentation wraps up for the day, we will be going through and looking at all those questions and answering as many as we have time for. There is no need to take detailed notes, as the presentation will be shared with all attendees within 24 hours via email, and the webinar will also be available on bankdirector.com. If you have any technical issues, you can note those using the moderator chat feature, also on the right-hand side of your screen, and we will do our best to take care of it. Regarding the poll questions, those will also appear in the sidebar near the Q&A button. So once you've selected your answer, all you have to do is hit the vote button, and that will submit your response. Finally, the opinions expressed in this webinar today are those of the individual speaker only and do not necessarily reflect the opinions of the other speakers or of the entities with which the speakers are associated. Now I'd like to go ahead and share a little bit about our speakers today. First with us, we have Karen Solomon, Senior Counsel at Covington & Burling. Karen advises banks of all sizes, fintech companies, and trade associations on a broad range of financial services, regulatory matters, and supervisory issues. Before joining Covington, Karen served as the Acting Senior Deputy Comptroller and Chief Counsel at the OCC. Welcome, Karen. Our second speaker today is Randy Benjank, a partner in Covington & Burling's industry-leading financial services group. Randy focuses his practice on regulatory advice and advocacy. He regularly advises clients on complex bank activities, structure, licensing, and prudential matters, often which include first impression at the federal banking agencies. So with that, Karen and Randy, go ahead and take it away.
Thank you so much. Thank you very much to the Bank Director team for having us today. We're really delighted to be able to do this session with all of you. Let me go through the agenda real briefly. We're going to start by giving an overview of what we see as 3 high-priority supervisory and enforcement issues at the federal banking agencies and the CFPB. Fair lending, oversight of third parties like vendors and fintech partners, and fees like overdraft, NSF, and credit card late fees. We're then going to give an update on 3 other regulatory topics: where things stand with the agency's review of bank mergers, the agency's CRA rulemaking, and banks' participation in the cryptocurrency market ecosystem. Our agenda for this session is based on what we are seeing as coming around the corner and what's currently going on with our clients, especially mid-size and community bank clients. But we also want to know what's top of mind for you and your institution. And to that end, we're going to start with a poll question, our first of the day, which is, what supervisory topic is of the most concern to your institution and its peer set right now? Just to be clear, when we go through the results with the group, we're not going to identify any individual voters or their firms when we share the results, so feel free to answer candidly if you'd like. The possible responses are safety and soundness, fair lending, third-party oversight, CFPB focus on fees, other consumer protection issues, BSA AML, cybersecurity and IT, audit, governance, climate risk, other risk management issues, and other compliance issues. Give a few more seconds for you all to vote, and then we'll announce the top vote getters. I think we're ready to close the poll at this point. So based on what we're seeing, the top vote getter is actually the CFPB's focus on fees. 32% of respondents said that that was the top concern to them. And then the next highest vote getter was fair lending issues with 24%. Not surprising based on the activity we've seen on the supervisory front. And then the third highest vote getter was cybersecurity and IT with 18%. So thank you all for letting us know what matters to you. And I think you'll find that at least with two of those topics, we'll be able to speak a little bit about what we're seeing. So let me turn it over to Karen at this point to talk about fair lending.
Randy, thank you. Welcome, everyone, and let me reiterate Randy's thanks to you for joining us today. We're delighted to be able to spend this time. Our first topic this afternoon is fair lending, and I'm going to just recap a few things that have happened lately, and then talk a little bit about what directors can do in the fair lending space. So in October 2021, the Department of Justice, in a press conference where the Assistant Attorney General was accompanied by the OCC and the CFPB, announced a significant new fair lending initiative. And that initiative indicated a focus not just by Main Justice, but also by U.S. attorneys throughout the country. In the months since then, we've seen evidence of increased focus on fair lending in the banking agency's policies, as well as in their supervision and enforcement activity. And just to mention one thing that the CFPB has announced lately is in its signaling that bank activity can be unfair, deceptive, or abusive, even if it doesn't technically violate fair lending laws. So the bottom line here is going to come up in a second. There it is. Banks of all sizes ought to be focused on fair lending compliance, especially ahead of examinations and especially in the bank's underperforming markets. And the question then for directors is, how does this affect your responsibilities? What should you be doing? And as you know, your role is oversight, in this case, compliance oversight, but you're not hands-on. You're not running the fair lending compliance activity at the bank. What should you be looking at? What questions should you be asking? And by way of background, I'll just say, as an example, the OCC does annual screening of HMDA data. For example, the information in the HMDA loan application register, or HMDA LAR, for every bank that it supervises that does retail lending. Directors should know what your bank's HMDA numbers look like. Are there any markets in which the bank is showing weakness or vulnerability? And especially if the bank has an upcoming fair lending exam, how is the bank preparing? banks should be not passive about this. They should be assembling a narrative, a description of why their performance is what it is in the particular markets that may be showing weakness, and also what the bank intends to do to remediate the situation. Being proactive in the bank's explanation of where it stands will add to the credibility that it has with the regulator in an examination. And being thoughtful about the planning that it's undertaking will tend to show the regulator that the bank is intent on achieving compliance and is prepared to take the necessary steps and commit the necessary resources to doing that. So describing honestly where the bank stands and why, and then having a strategy is a good way to think about preparation for an upcoming fair lending exam if the bank is noticing weaknesses in any of its markets. Finally, one other thing that the board should pay attention to is staffing at the bank. And again, you're not filling jobs particularly, but the board should be getting information that reassures it or causes it to question whether the bank is devoting adequate staffing to fair lending issues as well as to other compliance issues. I think with that, we could move to our next topic. Thank you. A second key area of focus, I think, and concern is third-party oversight. The Federal Reserve Board, the OCC, and the FDIC published proposed guidance in the summer of 2021, so it's been out there for a while. They solicited comments on what was billed as a revision to the agency's third-party risk management guidance. In fact, what they proposed was very, very similar to the guidance that the OCC already had, still has, and continues to apply. So the message that was sent was that the agencies would be sort of coalescing around the OCC's approach, and they were looking for comment on the content of that third-party risk management guidance and intended to finalize it in a way that all the agencies would issue it at the same time and they would all be on the page. A welcome thing to occur in terms of leveling the playing field. So that is one signal about third-party risk oversight that has yet to come to finality. The agencies have not yet issued final guidance in this area. They have, however, issued a final regulation. The regulation concerns notification to the regulators about computer security incidents. And one thing that's notable about this regulation is that for the first time, the agencies have applied it directly to third-party providers and not just to banks. This is based on authority that the agencies have in the Bank Service Company Act, which allows them to regulate the performance of services that are provided to a bank by a third party. Typically, the agencies will regulate by regulating the bank. In other words, they will require the bank to exercise oversight over third parties. And that approach is continuing, and we expect it will continue. But in this regulation, the agencies have also shown that where they think it's appropriate, they will write and apply to third parties directly regulations that have binding effect, that have the force and effect. So I think the last kind of what's happening point to make here is that we've seen increased supervisory attention, including enforcement activity focused on banks' third-party relationships. And our bottom line here, there it is. Federal banking agencies definitely ramping up their oversight of third-party arrangements, including banking as a service partnerships with fintech companies where we see barriers to entry increasing. This is an area that I would characterize as carrying some regulatory volatility. Things in the space are changing rapidly. Sometimes it's hard for a bank and its directors to know how much oversight of third parties is enough. For example, there is a concept known as fourth party risk that has come on the scene really almost since the agencies issued their proposed guidance in the summer of 2021. And that fourth party risk addresses what is the risk to the bank presented by the customers of the third party service providers that the bank uses. So the bank has third party partners, but the partners may have customers, for example, on whose behalf the vendor or the partner deposits funds with the bank. What risk does that fourth party activity propose? At the moment, the banking agency's guidance doesn't address that, neither the OCC's nor the guidance out there put out by the other banking agencies. But that's one thing that we wonder whether the agencies might address in the forthcoming third-party guidance when it's finalized. So the landscape is changing, is continuing to change. And the advice that we would have for directors is to err on the side for your bank, in your oversight of your bank, to err on the side of compliance, to sort of tilt toward applying to third parties standards similar to what the bank itself is required to comply with. That may seem like an onerous obligation, and it's not written down in regulation necessarily, but what we're seeing is agencies expecting that banks will oversee their third parties according to standards that would bind the bank. So, for example, a bank that engages in lending activity through a third-party partner, the regulator's expectation of that bank will be that the same underwriting standards will apply to loans that are made through the third party, as would apply if the bank itself was directly making the loans. What that means is that the bank needs to understand the risks inherent in its partner's business, and in some cases, the risks inherent in the customers of its partner, in order to adequately gauge its own risks. We think that there will be additional information and guidance in this area. The sort of risk, how far, how attenuated does your risk evaluation have to be? We think that will likely be addressed in the third-party guidance. But I think in terms of what your expectation and your preparation can be, thinking that the agencies will be stepping up their expectations with respect to a bank's oversight of its partners is a fair conclusion to draw. Randy?
Well, we have another poll question. Has your institution changed its policies on overdraft fees, insufficient fund fees, NSF fees, or late fees in the last 1 or 2 years? We'll leave this one open for seconds or so and then give you the results. And while you're all voting, one thing I just want to mention is that we have 3 poll questions today. You just need to answer all 3 of those in order to get the CPE credit, not 4 questions. I think we can end the poll and read out the results. So this one is kind of close. Looks like about 56% or so, 55% are saying, yes, our institution has changed its policies on fees, and 45% are saying, no, we haven't. It's not very often that the President of the United States remarks on our little corner of the economy, and when it happens, it's usually not a good sign for the banking industry. Usually bad things are to come. Lo and behold, President Biden's State of the Union address earlier this year included a shot at what the president calls junk fees. And according to the president, junk fees include resort fees at hotels that show up on your bill at the end that you weren't expecting, fees for switching your cable and internet providers, service fees on concert tickets that you only find out when you're checking out, and yes, bank overdraft and credit card late fees. And if you look at that list, I guess it's not really a great company to be in. If you've been following the news coming out of the CFPB since Director Rohit Chopra took office, this would not be particularly surprising to you. The Bureau has been very active in regulating overdraft, NSF fees, and late fees. And the CFPB has really been taking a three-pronged approach to regulating these fees. First, the CFPB is being aggressive in the supervisory and enforcement contexts when banks don't adequately disclose fees, and when banks do things like posting consumers' transactions in an order that maximizes overdraft and NSF fees and hurts the customer. If your institution has more than $10 billion in assets and you're supervised by the CFPB, you should know that you're not alone if you've had the Bureau examining these issues more closely than ever before. On the enforcement side, I think there's been one major enforcement action on this under Director Rohit Chopra, but you will surely see some more coming. The second part of the CFPB strategy is to name and shame the banks that are getting a lot of their revenues from fees, either as an absolute matter or relative to their overall income. The Bureau has done this by releasing charts of what it considers to be the worst offenders, being mega banks and tiny community banks alike. This tactic has worked incredibly well. Virtually all the big banks in the country have announced changes to their policies on overdraft and NSF fees. Sometimes they've eliminated the fees altogether. Sometimes they've dramatically reduced them. Sometimes they've changed the circumstances in which the fees will be charged so they happen less often. That trend has trickled down to at least some smaller institutions, particularly mid-sized institutions, maybe a little bit less so community banks. That's part of the reason why we asked the poll question that we did. The more banks that are out there that are reducing their overdraft and NSF fees, the more it makes the banks that don't adjust their fees stick out to the public, stick out to regulators, and that's not a great place to be, unfortunately, because it puts a little bit of a target on you from an examination perspective. The third element of the Bureau's strategy is rulemaking. Shortly before the State of the Union address, the CFPB released a proposed rule under the CARD Act to lower the safe harbor late fee that credit card issuers can charge, $41 to just $8. Huge reduction. The rule would also end the automatic inflation adjustment of the safe harbor and would cap late fees at 25% of the minimum payment on a credit card. Industry has tried to make arguments that late fees help cover the credit card issuer's costs. The industry has tried to make arguments that late fees actually serve a valuable deterrent that helps borrowers keep themselves out of financial trouble. The Bureau has been unsympathetic, and we see them moving ahead with this. So what's the bottom line here? The CFPB is increasingly regulating prices. Market practices are evolving really quickly, and outliers are attracting close regulatory attention. So if your bank has not yet benchmarked its fee policies with that of its peers, doesn't need to be a benchmark against the biggest banks in the country, but against peers, I think you really owe it yourself to do so. And do that periodically because things are changing quickly. Let me get to another regulatory update on mergers and acquisitions. Ever since the early days of the Biden administration, regulators have been conducting an interagency review of the standards they use to decide whether or not they can approve a bank merger. To date, the regulators have not released any formal changes to their standards. We're all kind of waiting around to see when they're going to do that and what the changes might say. Let me try to do a little bit of tea leaf reading, give you some predictions on what kind of changes might result from that review, and also give you a sense of what kind of more minor changes we're seeing happening on the ground within the agency's practices. As you may know, the agencies are required to consider a few different factors when they review bank mergers. So I'll talk about a few of those factors and organize my remarks that way. The first factor I'll mention is the antitrust analysis that the reviewing agency and the Department of Justice perform on any given proposed merger or acquisition in the banking world. The current practices for the agencies is sort of formulaic and somewhat limited. So what happens is that agencies plug deposit data into a calculator based on the location of deposits in markets where both parties have overlapping branches. That calculator spits out a number, and that number guides whether the acquirer needs to divest branches in order to ensure that the transaction is not anti-competitive. And that calculation has not actually changed yet. It could change in a few different ways. One is that the agencies could simply make the numbers tighter. That's simplistic, but some progressive groups have been asking for it. A second possible change is to look beyond that localized analysis. Everyone actually on both sides of this debate seems to acknowledge that the focus on local markets is perhaps outdated and at least misses part of the bigger picture, because banks are competing nationally, even where they don't have branches, and also because banks increasingly compete with non-bank lenders. So you could see a national overlay in the analysis, or there could be an attempt to quantify the competition within a local market that's coming from banks that don't have a branch in the market or non-banks that are coming into the market and lending. And that might actually be helpful to banks to look at things that way. It's not that easy to do that analysis today, but there are a bunch of rulemakings out there, including the Community Reinvestment Act rulemaking that I'll talk about, that would generate more data and might actually help the agencies do antitrust analysis in the bank merger analysis context. The third thing that could change here is that the agencies could start looking beyond deposits and start analyzing different lending markets. The agencies are going to start getting very granular data on small business lending through a CFPB rule. And then through the CRA rule, the agencies are going to get more granular data on auto loans and others. So those are new markets that the agencies could do competition analyses on. There is one aspect of the competition analysis that has changed in practice already. If divestitures of branches are needed to ensure that the transaction is not anti-competitive, there's at least one recent deal where the FDIC required the branch divestitures to be completed before the M&A transaction closed. And that's in contrast to the usual policy of allowing the M&A transaction to close so long as the acquirer has basically found a buyer to agree to purchase the branches that will ultimately be divested after the deal closes. So we're keeping our eyes on whether the other agencies are going to follow the FDIC's lead on this. The next review factor I want to mention is the managerial resources of the acquirer. Regulators use this factor to deny an application if there are concerns about risk management or compliance or other supervisory issues. Although frankly, if those issues are present, banks will basically be told not to file an application in the first place. We say that institutions get put in the penalty box where they can't get approval for an M&A deal if they're not well managed. So usually if they have a 3 rating or worse for management under the CAMELS ratings. I don't think that how the regulators interpret the managerial resources factor is going to change, but in the current environment, probably going to see many more institutions be put in the penalty box because CAMELS ratings are getting tougher across the board. We're seeing some grade deflation. Another thing to mention here is that the OCC in particular, but also the other regulators, are increasingly concerned about serial acquirers that grow and grow without their risk management and compliance departments also growing and commensurate with the activities of the bank. And so one thing we're seeing the regulators start to ask about, especially when reviewing like a merger of equals, is whether the applicant has the resources to handle, bigger size and handle integration of the target company. Last factor I want to mention is how the agencies look at whether a merger will serve the convenience and needs of the community. We are seeing community groups, especially the National Community Reinvestment Coalition, or NCRC, protest more and more applications and applications by smaller and smaller banks to engage in mergers. And we're finding that clients are getting protested even if they have outstanding Community Reinvestment Act ratings, even if they've got the greatest relationships with local community groups that might be members of that national group. And regulators want to make these community groups feel like they're being heard. And that just emboldens the community groups even more to protest deals. The protest can really slow down the application process. Generally, especially at the Federal Reserve, when a deal is protested, it has to then be reviewed in Washington as opposed to through the local reserve bank or local office of the regulator. And that really introduces an unpredictability to the review and can extend the review of an application, even if it's the cleanest application in the world with no hair on it, by several months, sometimes beyond. As a result of that dynamic, we're seeing more clients, especially large ones or mid-sized ones, that are located in markets where groups are particularly active, enter into what's called community benefits plans. And if you haven't encountered community benefits plans before, what they are is basically commitments by the bank that's doing an acquisition to do a better job allocating dollars into low-income communities and doing other things like that that help low-income people. And generally, the banks that have entered into these commitments have found that community groups back off and don't protest deals after the bank enters into such a community benefit plan. And so people are considering that more and more, even though no one particularly likes having to do it. One other point relating to convenience and needs. I think you might start seeing the agencies look more carefully at questions that they haven't traditionally focused on, like how many branches an acquirer plans to close, even how many employees are going to lose their job as a result of the merger. Just to give you an anecdote, last year we had a state regulator ask an acquirer to make a commitment that there would be no job losses for a period of time as a condition for the regulator to approve a deal. And you could see that approach being taken more broadly. And in another case, the FDIC required an acquirer to waive its ability to enforce non-compete agreements against employees of the target. So these are just a couple of examples of how regulatory agencies can use the levers available to them in the bank merger process to influence broader social issues. What are the key takeaways? At the moment, and especially at the Fed and OCC, things are mostly business as usual, especially for banks that, let's say, have $50 billion or less in assets, and certainly for those with, $10 billion and below in assets. Where the ground has shifted is that supervisory ratings have gotten tighter, community groups are protesting more deals, standards themselves have not changed materially. The FDIC has been a little bit less predictable. And finally, you might want to consider, if you're about to enter into a major transaction, whether a community benefits agreement makes sense for you in order to reduce the chances of getting a protest to your deal. Let me shift gears slightly to talk about the Community Reinvestment Act. Last year, the agencies issued a rule proposal to change how they review banks under the CRA. The proposal is really sweeping, and we thought it would be worth spending just a couple of minutes on what it would do and what it would mean for banks. As you all know, the CRA is a law that requires the agencies to review how well a bank is doing serving low and moderate income, or LMI, communities and LMI people, and to take those evaluations into account when reviewing applications to engage in mergers and acquisitions or for opening branches. Banks usually get reviewed every 3 years, times 5, with the review traditionally focused on mortgage lending, small business lending, and loans and investments that promote community development like affordable housing. And as part of the evaluation process, the bank will get assigned an overall rating of outstanding, satisfactory, or needs to improve, or substantial non-compliance. And in practice, the acquirer basically needs a satisfactory to get any deal of its approved. And that's why this really matters. In looking at the rule proposal from last summer and trying to keep this high level, there are a few key things about the proposal that stick out to us and we think you should know. First is that the most stringent requirements would apply to banks with over $10 billion in assets. The next tier of stringency is for banks with $2 billion or more in assets. The proposal is much less impactful for banks with less than $2 billion in assets. And finally, if you're at a bank with less than $600 million in assets, the proposal would largely leave your institution alone. Second point is that there's a lot of complexity in the proposal. And I'd say the complexity really kicks in at the $600 million and up range. A bank's performance would be sliced and diced in many different ways in many different geographies. And that means a lot of opportunities to be below average in a particular aspect of performance or a particular market. And even if that below average rating in one component of your performance doesn't affect the bank's overall rating, you could easily see community groups, politicians taking that information out of context and criticizing the bank. Third point is that the proposal would test new subjects that haven't really been subject of CRA exams in the past. So, for instance, the proposal would look at how a bank is doing in retail lending outside of its local markets where it has branches. And that's really a key concern for banks with $2 billion and up. For smaller banks, that out-of-market review would only be required if the institution does at least half of its retail lending outside of its branch footprint. As another example of testing new subjects, the proposal would include a very data-driven and rigorous method of reviewing how good a job a bank is doing reaching low and moderate income people and the small businesses relative to peers and relative to demographics of the area. And banks are really going to need to up their game to find more opportunities to lend to LMI people in LMI geographies, all while your peers are going to be doing the same thing, which just raises expectations even more. To make these tests operate, the agencies are going to require banks to collect and report a ton of new data, especially for banks with $2 billion or more in assets. For instance, those banks are going to have to collect data on the address of each and every depositor, geocode it in a standardized format, collect data on loan products that aren't covered by new data collection requirements. That's all going to be pretty costly, especially in startup costs once the rule comes out. The data burdens are less significant for banks with less than $2 billion in assets. The final thing to know is that the agencies are contemplating just a 12-month compliance period once the final rule is released. That won't give banks a ton of time to prepare, including by implementing the necessary systems for data collection. We think that the agencies will probably release a final rule in the next few months. That will cause banks to sprint to figure out what they need to do, not only to comply, but also to make sure they can continue to earn the same outstanding and satisfactory ratings that they and their stakeholders expect to see. So from an executive management and director perspective, you should have a plan to have a plan, because once the rule comes out, it will be a scramble to marshal the resources to do a good job on CRA. Everyone's going to be doing the same thing, so consultants will be stretched probably. We are going to do one final poll question before we get to our last topic of this session. This is about cryptocurrency. What is your institution's level of interest in engaging in crypto-related activities? And by crypto-related activities, we mean a whole gamut of things when it comes to banks. Anything from serving as a custodian for customer crypto, facilitating crypto payments and exchange from dollars into crypto for customers, issuing stable coins, making loans that might be backed by crypto. If you're interested, please answer the questions accordingly. The three options are: we are enthusiastic and actively looking for business opportunities, we are interested but cautiously watching to see what happens, and we are not interested at this time. I'll give just a couple seconds more. All right, why don't we close out the poll? This one is a resounding answer in favor of the third option. We are not interested at this time. 87% participants say that they are not interested at this time. 11% say we are interested but cautiously watching to see what happens. And 2% say we are enthusiastic and actively looking for business opportunities. So with that, Karen, tell us why they should be cautiously watching.
Thanks, Randy. I had a bet with myself as we were waiting for the poll results that number 3 would be the choice of most participants today, and in fact, that was right. Not a hard call, and the first line on this slide says why. Crypto has had a challenging year. My other challenge to myself was to write the most understated summary of crypto's recent history that I could, and I thought challenging year was about as good as I could do. Others refer to it as the crypto winter. My son complains bitterly that the value of his crypto has declined, and he's sort of in the hole right now. He is the most intrepid investor in our family. So yeah, the bottom kind of fell out a little bit over the last year and a half. And it's not going to surprise you that regulatory activity, regulators' activity, has accelerated accordingly. And it occurs to me that if you look back at the topics that we are raising with you today, pretty much all of them, and it's no accident, are here are the ways that you are going to be regulated even more heavily than you already are. This one, crypto, is a little more ambiguous than that because while regulators' interest has ratcheted up, it's not entirely clear how this sector is going to be regulated going forward. We'll talk a little more about that. But we have seen interest and activity, multiple enforcement actions from the SEC. I think Gary Gensler drawing quite a bit of attention to himself as chair and to the agency for his fairly aggressive entry into the regulation of crypto activity. On the bank chartering side, for a time, and I would say this was initiated by New York State, the New York State banking regulator, who invited and made it pretty easy is the wrong word, but made it very achievable for crypto companies to get trust bank charters. And that baton was kind of picked up by the OCC during the Trump administration when then acting controller of the currency, Brian Brooks, announced as he took office as acting controller that he was really interested in signing the first crypto bank charter. And he did. And there was a time, in that time, when the activity, the interest, what we saw, probably many other law firms and consulting firms saw, was a real interest in obtaining a bank charter, if possible, to conduct the activity in the regulated space, in part because many folks thought that it would be reassuring to their customers if they were in the regulated space, and therefore welcomed the opportunity to get bank charters for that reason. That has slowed to a trickle, which may actually overstate the activity. You're not seeing new chartering activity as much. You're not seeing it really at all at the OCC right now. And even New York has begun putting out more regulations than it is approving charters right at this moment. So that activity has slowed down to a crawl. The banking regulators have been discouraging, I think, again, is an understatement. The messaging out of the banking regulators has been extremely cautious, extremely conservative. One approach that all three regulators, Fed, FDIC, and OCC, have taken is to say to their supervised institutions, if you want to engage in crypto-related activities, you need to come to us first. And we will review whether you can conduct those activities consistent with safety and soundness and give you what I'm sure, as you all know, is called a supervisory no objection, which is interesting because what that does is it actually puts the agencies in the position of evaluating the risk assessment and management controls that institutions have and deciding whether they're good enough. Needless to say, that's a pretty steep climb, particularly in the BSA/AML area, where we would say that regulators are looking for banks to have nearly bulletproof BSA/AML programs in order to engage in crypto activities. The policy statements, the speeches, the testimony that you're hearing from the bank regulators is all kind of we need to slow down, we need to take this very carefully because this is an extremely risky area. Acting Controller Mike Sue will typically compare what's going on in the crypto sector right now with other tumultuous times in bank regulatory history. He gave a speech about how crypto is like BCCI in the early 90s, for those of you who were around then, or crypto was like the run-up to the financial crisis of a decade ago. Those are not words that indicate that banking regulators are going to be terribly friendly to crypto activity. At the same time, crypto doesn't seem to be just going away. And many people in the sector believe that maybe it will not achieve the valuation levels that it had before the winter set in, but that as an asset, digital assets, including crypto, are not going away anytime soon. So the question one question that raises is, what is the way forward from a policy perspective? There's not really coherent crypto regulatory policy right now. It seems unlikely, given the current configuration of the Congress, that there's going to be legislation. Just too hard to get legislation done. A broad span of difference of opinion between House Republicans, let's say, and Senate Democrats. Although one benefit of legislation, maybe the primary benefit, would be to keep regulators each in their lane and to define what those lanes are. But again, it doesn't look as though that legislation, that sort of relief or clarity, would come legislatively anytime too soon. So those decisions, like what's the right regulatory lane, who controls what, who has jurisdiction over what, those decisions are going to likely fall to the courts and to the regulators themselves. So just as an example, what's a security? What in the crypto sphere is going to be considered a security and therefore be subject to regulation by the SEC? That's likely to be an issue that is solved in the courts over time, and maybe pretty long time. I just saw yesterday that a judge in the Southern District of New York allowed a class action lawsuit to proceed against an NFT issuer. And the judge's conclusion was that the NFTs were securities, at least for purposes of overcoming a motion to dismiss. So I think we can expect to see more decisions like that in a variety of digital asset related areas. Certainly the bankruptcy courts are going to have an opportunity to issue rulings that may have significance beyond bankruptcy. But all of that will take some time to spool out. Meanwhile, the regulators are not shy about, as I said, continuing the messaging of caution and conservatism. So just the other day, the regulators put out a statement on liquidity concerns associated with crypto and urging, and this has a sort of relationship to the third-party risk management that we've been talking about, the regulators saying, if you are taking crypto, if you a bank, if you have crypto-related deposits, for example, if you are banking the reserves on stablecoins, or if you're in a third-party partnership and that third party is placing crypto or fiat currency associated with crypto in your bank, you bank need to understand the risks, and those risks are going to be different from the typical risks that you might have with depositors. The volatility is going to be different. It's going to be driven by different things, and it's your business as a bank to know what those risks are and to be prepared to manage them. So similar to third party, it casts the net of risk assessment and evaluation significantly beyond the bank to its and even beyond its depositors to the customers of those depositors if they are third-party vendors. So I think the bottom line here, which we didn't quite get to, Phil, is that some what some have called the crypto winter has heightened the federal banking regulators' caution about allowing crypto into the regulated banking space. And I just will remark, this is a really hard choice for regulators to make, because on the one hand, it's easy to imagine that activity outside the banking sphere can nevertheless pose risks to banks and to the broader financial system. On the other hand, inviting crypto into the banking sphere from the regulator's perspective runs the risk that there will be some contagion. If something goes wrong with crypto, that contagion will spread to other assets or other activity that banks conduct. It's a bit of a conundrum. And so far, the regulator's response to that conundrum has been, don't do it, but if you do, be extremely careful, have first class risk assessment, risk evaluation, risk management tools and techniques. And it remains to be seen whether, as regulators and businesses get more experienced with the assets in this sector, whether the reins loosen a little bit and the regulators are comfortable with crypto assets entering the regulated banking space. We'll see how that goes. So I think that brings us to the end of our prepared remarks, as it were, and we may be ready for questions.
Awesome. Well, thank you both so much. You covered a lot of content. I just want to remind all of the attendees, you can still submit questions in the Q&A box on the right-hand side. We have gotten a few in, so we'll see how many we can get to here. We have about 8 minutes left. So first question, Acting Comptroller Michael Hsu recently gave a speech about big banks that might be too big to manage. Is there anything in that speech that is relevant to smaller banks? Karen, Randy, not sure who wants to take that one, but either one of you.
Why don't I start, Karen? It's a great question. Cool. So Acting Comptroller gave this speech, I think, in January, and it caused quite a stir because in that speech, he talked about the problem of big banks being too big to manage, and then went on to lay out this like tiered framework of how he was going to the OCC was going to exercise its supervisory authority to solve that problem, including like enforcement action, supervisory matters, growth caps, which are pretty extreme, and then breaking up big banks, which is very extreme. And that part of the speech got a lot of attention, I think, in the media because of the implications for big banks. And I don't think that is really quite as relevant to smaller banks. There was one part of the speech that I think is helpful because for you all to understand, which is that the OCC continues to be focused on this issue of banks that grow a lot through mergers and don't do a good job integrating the operations of the target. And what often happens is that banks have these disparate systems from legacy target companies that are almost like taped together. They don't really talk to each other well. And as a result, there are like gaps in risk management, gaps in compliance controls, and so forth. And I think the OCC's view is that has led to some very big conglomerate banks that aren't functioning as smoothly as they should, and therefore they're too big to manage. But we see this problem pop up in the supervisory context, even for smaller banks. And I think that speech probably just reinforces that the OCC cares quite a bit about that issue of integrating banks after mergers.
Randy,
Karen?
Yeah, I agree with what you just said. The other point that might be worth taking for those who are not really big banks is that this is what the acting controller described, especially with respect to breaking up the big banks, would be, at least in my view, a very aggressive use of the OCC's authorities. And I think it's worth noting that this is a administration at the OCC that is willing to be quite proactive, even to the point of being aggressive about using the authorities that the agency believes it has. And that can be a lesson for smaller banks as well, not necessarily that they would be broken up, but that the authorities that the OCC wields, the agency will not be shy about using those tools.
Great, thank you. The next question we had come in from an attendee says, the CFPB funding has come into question. Is there relief coming?
I'm happy to take a stab at that, although I'm not sure what relief means. If the questioner means, is the CFPB going to be put out of business? Betting people, I think, would disagree on this. It's a pretty conservative court, as everyone knows. I think it is not outside the realm of possibility that the court would agree that the CFPB is improperly funded. I do think there's a strong pull on the court in the other direction, which is the consequences of the court's holding, if that's what it held, could be really earth-shattering in the sense that every adverse ruling, every adverse consequence, every penalty paid, every enforcement action endured could possibly be called into question. And that would mean years and years and years of litigation and potentially huge sums of money being paid out by the government, potentially, if the CFPB did not have the funding to do, or it properly had the funding to do what it did. So I think even some of the not the most conservative justices, but some of the conservative justices might be unwilling to sort of call that sort of consequence down. So I don't know how to call it other than to say I think it's a really, really tough.
Randy, do you have anything you want to add to that?
Well, no, well said, Karen.
Awesome, thank you. Okay, last question today. Someone had asked, what do we need to do to partner with fintechs if we haven't done it before?
Get your risk management ducks in a row is what I would say. I would say acquaint yourself, read the OCC's guidance on third-party risk management, and do that. As Randy was saying earlier, scale up your risk management and your risk evaluation capabilities before you start down the road of partnering, because the OCC is going to expect, and other agencies too, will expect that you have got those risk management systems in place before you begin the partnership activity.
Yeah, there was a time when banks could sort of dip their toes in the water more easily on this stuff. Do one or two partnerships on a trial basis and then figure out if they're any good at it and what their gaps are. I think what we're encountering is that new entrants are increasingly being expected to sort of scale up their risk management apparatus on day one, like as if they were going to do a whole bunch of partnerships together, as if the first one presented serious risk to the bank.
Great. Well, thank you both so much. As a reminder to everybody watching, you will receive the recorded version of this webinar within 24 hours, and it will be also posted to bankdirector.com. Karen, Randy, I want to thank you so much for your time today, your remarks, and the firm for co-hosting the webinar. And I want to thank everyone for joining us, and I hope you all have a great rest of your day. Thank you.
Thank you, Liz.
Thank you.